G'day guys, Steve Hogarty here from Open Wealth Creation. I'm a senior investment consultant and your WOD speaker today, your wealth workout of the day. We've had a few questions about people understanding negative gearing and how it actually works. So I thought I'd give you a live example today of how it might work for you. Excuse me, I need my specs because I'm half blind. What I've got here is I've got a tax sheet that shows income and the tax you pay. So for a first-time investor, I'm going to give a live example. Let's say we're buying a property today and it's around that median house price of around $500,000. If you bought it new, which is obviously the way that we do it because we want to maximise our tax benefits, it's just a profit and loss that we need to look at and how it works in a real live example. So let's say I was borrowing $500,000 and on interest rates today, it's say 5% and that's interest only. That's going to cost me around about $25,000 or $25,000 in interest payments. When you buy a property, there's a certain amount of costs that are associated with running that property as well. Typically you've got rates, insurances, the property manager's going to take a fee, he's also going to have a letting fee. There might be a small amount of maintenance that you need to take into consideration, and I'd always put in somewhere between $200 and $500 a year. Even with a new property, there could be just small things that need to be attention. You wouldn't think there would be much, but if you just budget on that, it's going to help you out. You're also going to have, obviously, a little bit of pest control. Today, the insurers are going to be a lot happier, depending in which region of Australia you're in, that you do a termite inspection as well, which is really important. These things are tax deductible. So we might be looking at anywhere up to, say, maybe $5,000 of expenditure. So before we get any rent coming in, we've got around about $30,000 that we need to think about that we're going to have to pay out just to hold that property. Now, if we do get rent, and hopefully we're going to get rent because we're in a capital city, we're going to have a good reliable rent, we could get on this property, let's be conservative and say $400 a week. So if we multiply that by 50 weeks, we're going to get $20,000 of rent in consideration. So there's going to be a $10,000 shortfall. People ask, how do we actually get that money back? It's really simple. We look at whatever income you're on and we say, okay, then you're on $90,000. So we've got an income here of $90,000, of which you're going to pay, if I look at my tax sheet here, we've got obviously tax of $23,100. Now, what typically happens from a negative gearing perspective is that this rent is actually deemed as income. So what we need to do is we need to add that $20,000 of rent, and that gives us a new income of $110,000. Then we look at what can we claim. The interest and the expenses are actually deemed as an expense against an investment, so we can take that away, which then gives us a new income of $80,000. Now the tax on that $80,000 is $19,200. So obviously there's a few $1,000s that we can claim. If you're buying a brand new property, and let's say this $500,000 property was made up of $250,000 for the land, and the house that we put on top of it was an extra $250,000, we're going to be able to claim all of that. And that's including all the pipes under the ground, all of your landscaping, every appliance, and it's broken into two components. You've got what they call fixtures and fittings, which is typically around about 10%, which is around $25,000. And then we get an allowance on the actual building, so everything else. So that leaves us $225,000, which we get an allowance of 2.5% for 40 years. So these amounts we can write off in two ways. We can either do it on a prime cost method, which means we have to write that $25,000 off in a 10-year period, which would mean $2,500 every year for 10 years. Or we can do it on what they call a diminishing value method is. So we've got our value and then we've got a time of 10 years. And what it means, we get most of it up the front and then we get the majority or the residual over that following 5 years. So what we're trying to do is we're trying to get as much as we can in the first 5 years and a little bit or the residual over that following 5 years. Now that's going to work out to, in the first few years, around about $4,000 to $5,000. And if we do 2.5% on that, it's around about $5,000 as well. So I add those two together, that'll give me another $10,000 claim, which will bring my tax down to a further $70,000, which is, if I look at my tax scale, around $15,700. Now if I look at the break there, I've got a difference here of, if my maths is absolutely terrible first thing in the morning, guys, but it's 7,400 I think it is, but let me just double check this because we'll go through it. We've got 23,100 minus 15,700. That equals 7,400. I should have relied on myself. So what I can do is I can take that 7,400 off that $10,000 shortfall, and all of a sudden this property is not costing me $10,000 as a shortfall. It's actually going to cost me $2,600, and if I divided that by 50 weeks, it's around about $50 per week. Pretty cheap to hold a property these days, guys. You should investigate it. See what you can do. Come and have a talk to us. We'd love to have a talk to you. All the very best. Hope that helps. Doing a bit of an explanation on negative gearing. All the best. Bye.